in the New Orleans office. Stakeholder liaisons engage community-based organizations to leverage communications of information for the benefit of America's taxpayers, just like we're doing today. I'm glad to have this opportunity to share important news regarding the Employee Retention Credit under the CARES Act and important news regarding the 2021 Advanced Child Tax Credit that will significantly benefit low and no income families. The Employee Retention Credit was originally enacted as part of the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act as we call it, which was signed into law by the President on March 27th of 2020, and it was subsequently amended by sections 206 and 207 of the Taxpayer Certainty and Disaster Tax Relief Act of 2020 and the American Rescue Plan of 2021. So we've got several acts that have impacted what we're going to discuss today. The Employee Retention Credit was designed to help employers keep their employees on the payroll. The credit is available to eligible employers regardless of the size, including tax-exempt organizations that pay qualified employers regardless of size, including tax-exempt organizations that pay qualified wages to some or all employees after March 12th of 2020 and before January 1 of 2022, with differing requirements depending on the tax quarter in which the wages are paid. So we want to bear in mind, this act here, all of the information that we're discussing, we've got 4 months remaining on it. But usually, with all laws, there are sometimes exceptions. Our exceptions now that we want to make sure we are aware of is that self-employed individuals are not eligible to claim the Employee Retention Credit with respect to their own self-employment earnings. Household employers cannot claim the Employee Retention Credit with respect to their household employees. Generally, government employers have not been eligible for the credit. However, certain government employers are eligible for the credit in 2021. Today, what I would like to cover the information as a for your situational awareness, which means my goal is for you to observe the information, see if it applies to you, and seek assistance if needed, as statistically, over 80% of businesses use a paid preparer. Now, the information that we will discuss today is divided into 4 sections. First, we want to understand who is an eligible employer. Once we understand that, then we want to look at what are the qualified wages that eligible employer were paid. Then we want to look at how do you claim it on your tax return, because that's the most important thing. You want to get the benefit from it. And last but not least, we want to look at how the Employee Retention Credit impacts other credits. So we want to make sure we are aware of that. Today, what we'll do is we'll look at the changes made to the Employee Retention Credit and contrast them with the 2020 rules. Some changes are prospective only, and some are retroactive. So we want to make sure we understand how the changes will impact last year as well.
Excuse me, Mr. Steele?
Yes.
Did you want to put your presentation up?
Yes, I would love to have it up. I thought it was up.
I thought you were gonna share it on your screen. I could get it up.
Can you pull it up? And if you're pulling it up, let's start with slide number 3.
Can everyone see the presentation?
I can see it.
Okay, thank you.
Perfect.
Slide number 3.
Slide number 3. Today, what we want to do is look at the changes made to the employee retention credit that is contrast to the 2020 rules. As I said earlier, some of the changes are prospective only, and some of the changes are actually retroactive. So we want to look at it from both angles. Under the original CARES Act, eligible employers could receive a fully refundable tax credit against Social Security taxes equal to 50% of qualified wages paid to their employees during the period March 12th of 2020 through December 31st of 2020. The credit was available to employers whose 1, operations were fully or partially suspended due to a COVID-19 related shutdown, or 2, gross receipts declined by more than 50% when compared to the same quarter in the prior year. So right now, we're talking about 2020, we're talking about a decline in gross receipts, but we're looking at 2019 in the same quarter. For employers with more than 100 employees, the credit was for wages paid to employees who were not providing services due to a full or partially suspension or a significant decline in gross receipts. But then for employers with 100 or fewer employees, the credit was for wages paid regardless of whether the employees were providing services. For wages paid after March 12, 2020, and before January 1st of 2021, the maximum amount of qualified wages taken into account with respect to each employee for all calendar quarters is $10,000. So that the maximum credit for an eligible employer for qualified paid wages to an employee is $5,000. Under the CARES Act, employers that receive loans under the Paycheck Protection Program were not eligible to claim the employee retention credit. Now let's look at the second act we talked about, the Relief Act. Part of the Consolidated Appropriations Act of 2021 made prospective and retroactive changes to the employee retention credit. For wages paid after March 12, 2020, and before January 1, 2021, the Relief Act made changes primarily to who is eligible to claim the credit by expanding the eligibility for the employee retention credit to employers that receive the Paycheck Protection Program loan. So we've got a significant change here. For wages paid after December 31st of 2021 and before July 1 of 2021, the Relief Act made substantial changes to the employee retention credit, including making the credit available for the first and second quarter of 2021, increasing the maximum credit amount that may be claimed per employee to 70% of the $10,000. So the first time it was 50%, now we're saying it's 70% of $10,000 of qualified wages per calendar quarter, expanding the categories of eligible employers, modifying the definition of qualified wages, and broadening the double benefit rule, which prohibited claiming multiple credits for the same wages paid. Let's go back to slide 4 to make sure we're on, okay, you're on the, stay right here on this slide right here. Under the CARES Act, the employee retention credit is a fully refundable credit for the employers equal to 50% of the qualified wages, including health plan expenses, even if no wages was paid to the employee. That employer paid their employee. The employee retention credit applies to qualified wages paid after March 12th of 2020 and before January 1 of 2021. The maximum amount of qualified wages taken into account with respect to each employee for the year of 2020 is $10,000. Therefore, the maximum credit for the eligible employer for qualified wages paid to any employee is $5,000, which that's your $5,000 maximum for year 2020. But the Relief Act increased the limit on per employee qualified wages paid after December 31st, 2020, and before July 1 of 2021, 50% up to $10,000 for the year to 70% of up to $10,000 for each quarter. So the maximum employee retention credit amount for the first and the second quarter of 2021 is up to $7,000 per employee per quarter. So under the American Rescue Plan, the limit on per employee qualified wages paid after June 30th of 2021 remains 70% of $10,000 for each quarter with a maximum of $7,000 per employee. So keep that in mind. Let's go to the next slide. The next slide talks about an eligible employer. So we wanted to know, make sure what was an eligible employer and what were eligible wages. An eligible employer includes employers of any size that carry on a trade or business during the calendar year 2020 and either one, have operations fully or partially suspended during any calendar quarter of 2020 due to orders from an appropriate governmental authority, or who experience a significant decline in gross receipts during the calendar quarter. Tax-exempt employers are eligible for this credit. For 2020, a significant decline in gross receipts is calculated by determining the first calendar quarter in 2020, if any, in which an employer's gross receipts are less than 50% of its gross receipts for the same calendar quarter in 2019. The significant decline in gross receipts lasts until the calendar quarter after the first calendar quarter in which gross receipts are greater than 80% of the gross receipts in the same calendar quarter in 2019. Now for 2021, the definition of eligible employer changes. The same rules apply regarding full or partial shutdown, but who is an eligible employer and how gross receipts are calculated changes. For 2021, certain governmental employers are eligible for the employee retention credit. The employee retention credit is not available to the government of the United States, the government of any state or any political subdivision thereof, or any agency of instrumental of those governments. However, for 2021, an exception exists for any governmental entity if the entity is a college or a university, or the principal purpose or function of the entity is providing medical care or hospital care. So I tell you, you got to watch out for those exceptions. For 2021, a decline in gross receipts is defined as a quarter where the gross receipts of the calendar quarter are less than 80%. So now we're changing it. It's less than 80% of the gross receipts in the same calendar quarter in 2019. Let's go to the next slide. Now we want to talk about qualified wages. As I said earlier, first thing we want to make sure of, who is a qualified employer? What are your qualified wages? So now let's talk about the qualified wages. Qualified wages are wages as defined in section 3121A of the Internal Revenue Code. As I told you, I'm really giving you this information as a situational awareness because it talks about codes, which I know a lot of business owners may not be aware of, but you want to seek assistance to make sure it applies to you. But it's for compensation paid by an eligible employer to some or all employees after March 12th of 2020 and before January 1 of 2021. Qualified wages include the eligible employer's qualified health plan expenses that are properly allocable to the wages. The definition of qualified wages depends in part on the average number of full-time employees employed by the eligible employer during 2019. So you have to look at both years. You're taking it in 2020, but you're looking at what was your business in 2019. If the eligible employer averaged more than 100 full-time employees in 2019, qualified wages are the wages paid to an employee for time that the employee is not providing services due to an economic hardship, specifically, 1, a full or partial suspension of operation by order of government authority due to COVID-19, or 2, a significant decline in gross receipts. For these employers, qualified wages taken into account for an employee may not exceed what the employee would have been paid for working an equivalent duration during the 30 days immediately preceding the period of economic hardship described in 1 or 2 that I just described. If the eligible employer averaged 100 or fewer full-time employees in 2019, your qualified wages are the wages paid to any employee during any period of economic hardship described in 1 or 2 above. Next slide, please. Here's the third thing I told you we wanted to make sure we address. Eligible employer, qualified wages, important thing, how do you claim it? In order to claim the new employee retention credit, eligible employers will report their total qualified wages on their employment tax returns. For most of you, that will be your Form 941, for most of you. In anticipation of claiming the credit, employers can retain a corresponding amount of the employment tax that otherwise would have been deposited. And that can include federal income tax withholding, the employee's share of Social Security and Medicare taxes, and the employer's share of Social Security and Medicare taxes for all employees up to the amount of the credit without penalty, taking into account any reduction for the deposits in anticipation of the paid sick and family leave credit. You got to watch out for that. In 2021, small employers may request an advance payment of the credit. So you have to watch out for that. In 2021, advances are not available for large employers. The credits are fully refundable because the eligible employer may get a refund if the amount of the credit is more than the federal employment taxes the eligible employer owes. To the extent the credit exceeds the employer portion of employment taxes due, the credit is treated as an overpayment and is refunded to the employer. Next slide. Let's talk about some of the things that impact the credit. Show you that. An eligible employer's ability to claim the employee retention credit is impacted by other credit and relief provisions. Retroactive to the March 27, 2020, the new law allows employers who receive the Paycheck Protection Program loans to claim the employee retention credit for qualified wages that are not treated as payroll costs in obtaining forgiveness for the Paycheck Protection Loan Program. Qualified wages not reported as payroll costs on a Paycheck Protection Program loan forgiveness application may be now used to claim the employee retention credit. So you want to watch out for that. Next slide. Okay. Go back one more. Want to talk about the impacts of the provisions, things where you can't really double dip. An eligible employer's ability to claim the employee retention credit is impacted by other credits and relief provisions claimed as follows. I told you I wanted to talk about who was an eligible employer, what were eligible wages, how do you claim it, and how it impacts other credit provisions. So, an eligible employer's ability to claim the employee retention credit is impacted by other credit and relief provisions claimed as follows. Wages taken into account and determine the employee retention credit do not include wages counted for the following credits: credit for increase in research activities, Indian employment credit, employer wage credit for member of uniformed services, employer credit for paid family and medical leave, amount of credit, amount of work opportunity credit, and the empowerment zone employment credit. An employer may be able to take a credit for those sections with respect to wages paid the employer did not use to claim an employee retention credit. A double benefit is not allowed. For 2020, the double benefit restrictions was limited to section 45S, which is the employee credit for paid family and medical leave. Additionally, employees were not included for purposes of the employee retention credit if the employees were used to receive a credit under section 51, which is the amount of work opportunity credit, such as an employer could not claim the employee retention credit and the work opportunity credit under section 51 for the same employee for the same period of time. Can't double dip. For 2021, the double benefit restriction was expanded to include sections 41, 45A, 45P, 45F, 51, and 1396. Therefore, the double benefit restriction for section 51 purposes is significantly slightly different in 2021 because it applies to wages used for the credit. Now, under the American Rescue Plan, these sections 41, 45A, 45P, 45A, 51, and 1396 were moved out of the denial of the double benefit provisions to an exception provision in qualified wages section. Therefore, for the third and fourth quarters of 2021, any wages taken into account to claim any of the listed credits cannot be taken into account for purposes of the employee retention credit. Next slide. This slide here gives you some resources that you can find on our website, and we always want to give you some resources to support any type of presentation we do. But as I said from the very beginning, I know this is kind of a technical topic, and as a business owner, you may not know all of the various tax laws. So I wanted to give it to you as more of an informational awareness for you to try to absorb it. Go back, see if it applies to you, then seek assistance to make sure you don't make any mistakes in claiming the credit. Next slide is some additional resources that you can use to help you understand how the credit applies into different quarters. Because this credit here actually has basically 3 laws that is impacting it. It's impacting it over a 2-year period of time, And really, it's a 3-year period of time when you factor in, you're looking back at to what was occurring in your business in 2019. And you've got different type of restrictions. So I'm really hesitant about presenting this type of material to business owners. So I want to give it to you as an informational awareness and say to you, seek assistance to make sure you don't make a mistake on your tax return. Last slide. I thank you for the time that you've given me. And I had 30 minutes, so I always live within my time. The other information that I gave you that hopefully that PowerPoint was shared with you was information on the 2021 Advanced Child Tax Credit Payment. And that is basically the $300 payments that we started rolling out July 15th. The goal that we're trying to do is make sure that everybody who is qualified for the credit receives it, is aware of it. If you don't want to receive it, we've got information on our website where you can go online and you can tell us that you don't want to receive it. And that way we will not pay you the credits for the remaining months of September, October, November, and December. We don't want someone to receive it and then when they file their tax return next year, learn that they've received it and their refund will be smaller. So we're trying to make sure we get the message out about that to make sure no one makes that mistake. I'm going to turn it back over to you, Margaret, and I will be here when you get ready to start the question and answer.
All right, thank you so much. I will share both presentations with everyone that attended this session today. I'll send that out to you either later on this afternoon or tomorrow. So now we'll go ahead and turn it over to Mr. Stephen.
Thank you, Margaret. Everybody can hear me? Y'all good?
Yes.
All right, I'm going to try to share my screen and y'all bear with me. So you see my nice little slides? Y'all can see it now?
Yes.
Okay, so I'm going to talk a little bit about the employee retention credit. We had done this presentation a couple of times now, but mainly, you know, it's kind of like what Mr. Aaron had said and did it very eloquently. It's a complicated credit. One that if you see you qualify, my advice is to seek guidance or assistance in preparing it. It is a very beneficial credit. So I encourage people to see if they can pursue the credit. But like I said, it is a complicated credit to make sure you follow it accurately and timely on your 941s. So I'm going to kind of go through some stuff. There'll be some repetition. I'll try to skip over as much as possible when it comes to that. And then, as we said, at the end, we can open it up for questions. So general overview, consideration in the decision process, claiming the credit, and emerging issues. And that's going to be the four little parts that I'm going to touch on. One of the main ones is how the credit came around. Like Mr. Aaron had said earlier, there was several acts, the CARES Act being one, the Consolidation Appropriations Act, and then the Rescue Act that all impacted it. I'm going to skip over these slides because really what we need to do is look at this slide right here. This is a little quick one-stop shop to look at these items. So the covered wage period under 2020 is March 13th through December 31st of 2020. And in 2021, it's January 1st to December 31st, 2021. As it stands now, there is, y'all probably heard of the infrastructure bill that's out there. If the infrastructure bill passes as is, there is a stipulation there where the credit may be shortened to just include the third quarter of 2021 and exclude the fourth quarter of 2021. But that still has to be passed. And so as of now, it is exactly as stated, the whole year of 2021. The amounts of the credits, very simple. 2020, 50% of wages up to $10,000 of qualified wages per employee. So that's a max benefit for the whole year of 2020 of $5,000 per employee. For 2021, it's very advantageous. 70% of wages, so that's $7,000 per quarter per employee max. When you look at that, if a person qualifies for all 4 quarters, that would be $28,000 worth of credits per employee that a small business owner may be eligible for. So we talked about small employers. The biggest reason why you want to be a small employer is it makes it easy to qualify wages. In 2020, it's no more than 100 full-time employees. And then in 2021, it's no more than 500. As stated by Mr. Aaron Steele, everything is looking back at 2019. The reason why is that is a pre-COVID year and they needed a baseline year. So when you're looking at small employer, the full-time equivalents, the full-time employees, you have to look at your 2019 year. Gross receipts, 50% decline in gross receipts for 2020 compared to the same calendar quarter in 2019. And the gross receipts test for 2021 is only a 20% decrease of 2021 calendar quarter compared to the 2019 calendar quarter. There is this election of an alternate period, which means you get to look at the preceding quarter. So I was in quarter 1 of 2021. I could look into the preceding quarter, which would be December 31st, 2020, and see if I had a 20% decrease. So eligibility, what makes you eligible? We just talked small versus large. We'll talk a little bit about qualified wages, and we'll talk a little bit more about health plan expenses. As Mr. Steele said, part of this is just giving y'all some information of where can I find some answers. The IRS has a great website. They did a phenomenal job answering some of these questions, and they break it apart. So if you look at the frequently asked questions on this link, you can see little sections of how to determine how I get qualified, what is a gross receipts test, what's included in gross receipts. They have sections of what is a government shutdown, how do you document it. Also notice 2021-20, and I know many of y'all probably do not read revenue information bulletins, but if you pull up this notice, pages 17 to 102, they have examples and answers to every question possibly you could think of. The IRS did a real good job of trying to get ahead of the curve on this one and addressing the issues prior to people starting to file inaccurate returns. The next two slides are very important. If Margaret makes it available to all y'all, it would be great. These are flow charts to kind of help you work through the process. One of the things is, how do I qualify? But then the other part is doing the calculation. This will get you through, do I qualify or not? And so there's different rules. There's aggregation rules, which mean if you own multiple businesses, you may have to lump them all together to see if you qualify. But we're going to kind of keep this real basic for the time of our presentation. So if you look at the employee retention credit, if you start at the beginning, did I suffer from a full or partial suspension of my business operations due to government? Yes or no, you just follow it. If it's a no, you can look at gross receipts and you kind of just work your way down. And if you can see where you get to a yes, IRC for this quarter, well, that's when you probably need to reach out to somebody, because look, these credits, like I said, can be large. And so you just want to make sure you're following it right. Plus, as I have dealt with the IRS for 20 years in my career, if you start getting returns that are wrong or incorrect and you file them, it's trouble to have to get those all corrected and make sure all the deposits are matched up correctly, all your refunds are matched up correctly. So look, take the extra time, get someone to help you, get the assistance you need. So this is also, the first one was for 2021. This is for 2020. Similar, remember 2020, it's only $5,000 for the full year, but similar flow chart to kind of help you work through the process of if you are eligible. As Mr. Steele said in his eligibility, there's two criteria basically. One, the employer business is fully or partially shut down by government order due to COVID during a calendar quarter. And criteria number two is the gross receipts test, as it likes to be referenced. In 2020, it's 50%. And ends when you exceed a quarter of 80%, when you get back up to 80% of your full amount of gross receipts. And in 2021, if you had a decrease of 20%, you qualify. So the next slide too is about small versus large. In 2020, that's 100 employees or less full-time employees, you're considered a small employer. In 2021, if you have 500 or less, you're considered a small employer. This is a full-time employee defined as. It's different than what we typically have used for SBA, which was 40 hours per week. The IRS defines it as at least 30 hours per week or 130 hours per month. And then it talks about how to calculate your full-time employee. Aggregation rules, let me tell you what, if you have multiple businesses, this is a very complicated consideration. The Internal Revenue Code that's associated with this, you have to kind of work through. Many of our clients that do this, it does take some time, but if you see you qualify and you have multiple businesses, whoever you talk to, you need to let them know business so they can see rules apply. All wages. So once you qualify, the next thing is what are wages that I can use for the credit? So as he said, smaller wages is wage to employee during the period. Large employers, it is less. So you have to watch that. Ooh. Sorry about that. Qualified wages is FICA wages. If you're used to 941s, they call them FICA wages. But basically what you're going to do is look at your wages reported on your 941, and then you're going to look at if you have health plan expenses, and it's limited to $10,000 per year. For 2021, it's $10,000 per employee per quarter. Wages that do not qualify is used for PPP loan forgiveness. As Mr. Steele stated, the IRS is making you do not double dip. Say for a former employee, owner employees, self-employed individuals. Then there's a list of ownership. So individuals that have family members that work in their business need to have assistance probably in determining whose wages qualify, because they may have to exclude some individuals. As it relates to health plan expenses, these are group health, dental, vision plans paid by the employer, COBRA payments, contributions to health reimbursement arrangements, FSAs, what they call flex spending accounts, and contributions to health savings, excludes contributions to health savings accounts. So once you know what you have and you can quantify your qualified wages, the next step is calculating the credit. 2020, 50%, 2021 at 70% of qualified wages, capped at $10,000. The employer can hold back credit amount from federal employment tax deposits or applies for the refund of the amounts of the credit in excess of their liability. And so I just ran some examples so you could kind of see when we talk about numbers and 70% and 80%, it gets kind of lost, but this credit is very advantageous. So if you look at example one, say I calculated a credit. I had one employee, I got lucky, $5,000 in 2020. There's taxes due of $8,000. I could have just paid $3,000 worth of taxes with a balance due, and I would have been able to keep the $5,000 in pocket cash-wise. In example two, if the credit calculated to be $10,000, so let's say for 2021, and the taxes due are $8,000, the employer can withhold $8,000 credit from the $8,000 the taxes due and deposit zero, so you don't pay any deposits into the IRS. And then you could actually apply for the advanced tax credit through the Form 7200 and get the $2,000 refunded to you. And example three, which is what I've seen most common, is because of payroll taxes and the timing of payroll taxes and when you pay them, sometimes you might not know when you have qualified wages and what those qualified wages are until after the quarter's over. So typically what ends up happening is you pay in your federal tax liabilities as you incur them, you know, and so either your monthly or biweekly. And so as you pay them in, you may have paid in already your $8,000 worth of taxes due. So you file the 941, and on the 941, you can get a claim, a refund of $10,000. And that's what we've seen most with our clients is typically they've stayed on top of their payroll taxes. And then when they file their 941, which is their quarterly federal income tax returns, get credits on that return. So as Mr. Aaron stated, what happened was in late December, very late December, there was finally guidance issued that said that PPP loan participants could actually qualify for these wages, these credits. And so what ended up happening was many people already filed their second, third, and fourth quarter 2020 941s. And they were like, we can go get credits now that they're eligible. So what you need to do at that point in time is file a 941X, which is an amended return. And you can go back in 2020 and pull the credits back. That being said, I'm going to make this disclaimer. If you go back to claim credits in 2020 and you have filed your business or personal tax return, you may have to amend your business or personal tax return because the IRS had came out with guidance that said, if you go back to a year, you have to discount your wages claimed as a deduction on those tax returns in that year. So in other words, if you amend the 2020 return for 941 purposes, you might want to talk to your tax preparer as you probably have to amend those returns that are associated with your business. And in 2021, thank goodness we haven't filed those returns, but you can either file a 941X for the first or second quarter since they've already been filed, or like I said, you can claim it on your 941 for the third, fourth quarter. Or if you think you're going to have a credit that's substantial and you want to get your credit quicker, you could file a Form 7200 for the 2021 quarters. The merging issues, one of the things we've read in the law is if you have a tax return, the reason why it's very technical, as Mr. Aaron said, is because if you are a cash basis taxpayer, when you compute your gross receipts, you have to do it on the same basis. And some people have books on a different method. And so the reason why I'm telling you this is it's not as quick as it sounds sometimes that you can just check the box and you need to work with whoever prepares your tax return possibly. If you go through an outside source like ADP or Paychecks, which are large payroll providers, they have an understanding of how to claim the credit. So you may have to depend on others to help. But because the credit is so substantial, once you think you qualify, it's probably very worth your while to pursue it. PPP participants need to coordinate with employee retention credits. You can't double dip, as Mr. Steele provided. So if you cannot double dip, you need to make sure you have enough wages to qualify for your PPP loan forgiveness. And then you should see if you can get employee retention credits. And the reason why I say this is the PPP loan is more advantageous to get refunded and forgiven than just to go get employee retention credits. And because a credit is not as valuable as loan forgiveness. Also remember, there is people who have deferred, or employers who have deferred their payroll tax deposits. Those are coming due. They need to be paid 50% in 2021 and the other 50% in 2022 of December. That was part of the CARES Act. Like I said, all these COVID relief packages really are intertwined. And when you're working through these processes as a small business owner and as a small business advisor, we are aware that it can get cloudy, it can get difficult to maneuver, and it's a lot of information. Look, I've read this 100 times, and to say I'm 100% concise on everything, you get mixed up. PPP has their own set of standards that you have to follow. This employee retention is different, but if you can work and maneuver, it can be highly valuable to your business. And that is one of the reasons why we started presenting on this matter. Like I said, the credit reduces your tax deduction on the wages equal to the credit you claim. So if you amend to 2020 and you get a credit, you're going to lose that deduction for those salaries. You have 3 years to amend your non-41s. So you have time to do this, but remember, if you amend a 941, you may have to amend other returns. And there was some additional guidance that just came out regarding owner employees. The IRS notice, I put it on here. It is quite difficult to maneuver through, to be honest, because it references 2 sections of the code. But if you thinking that you can qualify, it may be worthwhile to pursue and talk to your tax preparer. And that's about it. I kind of flew through it because Mr. Aaron did a great job touching on most of his points. As of now, Margaret, I can open it up to any questions, I guess.
Yes, do anyone have any questions at this time? We'll give them a couple of minutes. I know everybody is pretty much on mute. If there are no questions at this time, I'll go ahead and say I would like to thank Mr. Aaron and Mr. Stephen for being here today, for their very informative presentations. To all of you for attending. I have included everyone's email in my database, so you will receive notification of any future business information sessions that we may have. I would also like to ask each and one of you to maybe write a brief paragraph telling about how this session may have helped you in any way. Also, if you have any ideas for future sessions, put that information, and if you can, email it to me. My email is momagee@nola.gov, and I'll also put it in this chat section. Email me that information, and it could help me with future sessions. Again, I'll open it up and see if there's any questions at this time.
Margaret, I'll ask a question. I've heard that in the current infrastructure bill, there is a stipulation that would cause the employee retention credit to end in Q3 of 2021 and not to extend to Q4. I was just wondering if either of the speakers has heard more about that.
Courtney, so what we have read, so there's 2 parts to this. So as it stands right now, yes, if the bill would pass, it would stop at September 30th, the 3rd quarter of 2021. It still allows you to go back and get the credit for other quarters in 2020 and 2021. There has been discussions of eliminating it and letting it run to 12/31. And the reason why is the IRS actually had created their the 941s to run through December 31st a certain way. And this would end up having now 3 different revisions of the 941. So there is hope that they do keep it extended to December 31st. Also, as I stated earlier about the amendment of returns, there is talk about them approaching the House Ways and Means Committee, who would have the ability to say, look, you don't have to go and amend your old returns by carrying back those credits for 2020. But those are all hypothetical or in process. And as of right now, as it stands, the credit is available through December.
Thank you.
Any other questions? Okay, if there's no other questions, sometimes you have to give a little more time because some of us are a little shy. But if there's no more questions, we'll go ahead and conclude the session for today. Thank you all for joining, and I hope to see you all again.